Pete, one of the arguments out there is that if this inflationary trend is sustained, then it will dramatically cut back on consumption. These things will be just too expensive here. I mean, how does that play into what is called the recovery from the pandemic? Because we could go through a W, a V, a K, all the alphabet letters here. But how is that going to affect the recovery, and who's going to be hurt most? We've already mentioned working people. Go ahead, Pete.
So the problems of inflation fall most heavily upon people who have either low income, the working poor, and also people on a fixed income, because the reduction of the value of dollars while receiving the same amount of dollars basically winds up being a sort of a tax. I pointed out before that the CPI numbers are a little bit misleading, but we have seen classic inflationary effects in both financial markets and in commodities, which is perfectly in line with both economic theory and history. Lumber prices rose something like 800% over an 8-month period. Stock indices have skyrocketed. There's weird price spikes in places like Pokemon cards and non-fungible tokens. So while the CPI number, is kind of a nothing burger so far, we'll know in a few months, we're receiving a lot of mixed signals, but commodities, whether it's lumber or whether it's food commodities, all that sort of thing, affect everyone. So it won't be long before these price increases do start to affect everybody, but disproportionately, we're going to see an effect on the poor and people on a fixed income.
Okay, Sophia, in Moscow here, I mean, just 30 seconds before we go to the break here, I mean, is there any kind of coordinated global approach to dealing with this problem? Because it's growing in magnitude and it's coming fast. Go ahead.
Well, I would say that now the monetary policy response is discoordinated again, just because emerging market already started the normalization cycle of the monetary policy. So we are moving closer to neutral rates, somehow offsetting the effect of the increase of the rate. And I think that importantly, what we see now is that very unusual dynamics between emerging market and developed market. Like, for example, the U.S. inflation is now higher than it is in most emerging markets that I look at.
All right, let's go back to Peter in Weston. Peter, we've talked about how economists look at this. We have 3 economists on the panel here, and all of you make a lot of perfect sense to me, but it's really a political problem at the end of the day, because a lot of promises have been made, promises are going to be made here. It's about how we get out of this crisis here, and the powers that be have decided you spend your way out, okay? And all 3 of you have enumerated so far in this program the immense dangers of it, and they don't have the downside like the rest of us, okay? Working people, they're the ones that are going to suffer the most, and they will be a backlash. At least 3 of us here remember the 1970s and stagflation. Go ahead, Peter.
Well, of course it is political. I mean, the Biden administration, every member of Congress wants to give the voters something for nothing, right? The government wants to make sure that all the people who don't have jobs, many of them, of course, are just choosing not to have jobs, but the government wants to make sure that they have plenty of money to spend, even though they didn't earn that money, even though they didn't help produce any goods or provide any services. The government wants to give them money to buy goods and services. Well, where's the money coming from? They're not raising taxes. They're just spending the money. And so the money is being created. It's being conjured into existence by the Federal Reserve. But that is inflation. You see, every single dollar that the federal government spends, the American public has to cover the cost. And so if they're not going to take our money through taxation, they're going to take our purchasing power through inflation. And so they print all this money, the government spends the money, but the Federal Reserve prints the money, and it goes into the economy. And now as non-productive, unemployed people go to buy stuff they didn't help produce, all that happens is the price goes up. And it's amazing that people don't understand, or they expect that we can have all this stimulus, all this government for free. There is no such thing as a free lunch. Government spending is going to keep getting worse. And of course, as government spends more, it weakens the economy, which means even more spending. Inflation is going to go through the roof. And we keep talking about the 1970s. What we're going to experience is going to be far worse. And in fact, it probably already is worse than the 1970s. If we were using the CPI that existed back then to measure prices right now, we would see that the CPI is already rising at a faster rate than it ever did in the 1970s, and we're just going up from here.
Okay, well, let me go to Pete in Great Barrington. I mean, but then how does all of this end here? Because it seems like we're chasing our tail here. Because you can pump in all of this money here, but if people can't afford goods, then you're going to start seeing sectors of the economy collapsing here. I mean, how do you get out of this trap? This trap of just keep pumping money, because the more you pump, the less it's worth. Go ahead, Pete, in Great Barrington.
Someone's going to have to be the adult in the room and eventually have to take the action that will end this. In the late 70s, it was Paul Volcker. We don't know the name of the person, at least I don't think we do, who do it this time. But the government tends to prolong these things and generate more and more unintended consequences. As inflation started to rise in the 70s, Nixon put on price controls, and then a host of other things happened. About 50 years ago, actually, almost to the date, a few months away, we had the final severing of the dollar from gold. That was, I think, August 15, 1971. And so eventually somebody is going to have to be a really unpopular person and either try to choke off the flow of new money into the money supply, or maybe you would hope that they would look at the incentives that the Fed faces, which are highly asymmetrical. Everybody loves lower interest rates and more money, but people don't usually like rising interest rates and a decrease in the money supply. So someone eventually is going to have to rise up and do the unpopular things. And although they won't be liked for it, they will be doing the right thing, and they will be doing something really sort of heroic portions at that point.
Okay, Sophia, here in Moscow here, I mean, how is this going to affect emerging markets? I mean, first of all, a lot of these economies are still feeling the very strong impact of the COVID crisis. I mean, Western news agencies tend to focus on Western countries here, but when you look at countries, go through Asia, we have India has a major crisis still dealing with it, South America also here. I mean, how is this going, if we have a surge of inflation here, and we still have these supply chains that are, been cut or very, very weak here. How does the global economy recover from this? Because governments are always looking at single countries here. But if we look at it broadly here, I mean, it seems to me they're going to be very much on the short end of the stick here. I mean, you start recovering, and then all of a sudden you get this huge wave of inflation coming at you.
Well, yeah, Peter, it's exactly the point. So COVID is still here, and the worries are still here. So all eyes not only on developed market, but also on emerging markets itself. The problem is still here, and uncertainty is still here. But again, I would note 2 points here. And the first that I was already talked about is that inflation is high in emerging market, but sometimes it's even lower than it in developed market or in US now. So that's actually makes the position in financial markets. It actually means that emerging market currencies could potentially gain from this new reality, let's say. So they potentially could feel stronger than US dollar going forward. That's the first. And the second point is that probably, yeah, we could be in a case of 17th, but we could also be in the first half of 2008, just because I remember that it was a hot topic of global inflation as it is now in the first half of 2008, and it ends up with a huge correction in financial markets and credit defaults. So I think that though I'm not that concerned about sustainable inflation, I'm pretty much concerned about credit bubbles and potential credit risks and the potential correction that could follow. So we only could wait for let's say another black swan to come to just trigger the correction that could be a very broad-based.
That's exactly where I wanted to go. Peter, in Weston here, I mean, what we see here with all of this cash injections here is this huge, I mean, we talked about like the housing bubble, but I think almost every sector is turned into a bubble right now. It's really quite terrifying watching it here. The amount of money that is being pumped in over the last 14 months, it's hard to comprehend, and it's out there, and it's just not housing. It's just not one sector. It seems to me this is like a perfect storm to collide. Go ahead, Peter.
Oh, sure. Because of the Federal Reserve and these reckless monetary policies, just about every single financial asset is dramatically mispriced. And that has, tremendous distortions in the economy and massive negative implications. Just look at the bond market. Look at the yield on a 10-year U.S. Treasury, which is below 1.5%. It's like 1.4%. Inflation is 5 times that. And look at the yield. There's no way that yield reflects reality. It reflects fantasy, and everything is priced to fantasy. You have the extreme examples in meme stocks or cryptocurrencies, but the Fed has done tremendous damage, and there is no savior on the horizon that's going to do the right thing like Paul Volcker, because the consequences of doing the right thing are so horrific at this point that they're never going to be tried. But of course, the consequences of continuing to do the wrong thing are even more horrific, but that's what's going to happen because politicians don't give a damn about that. All they want to do is kick the can down the road as long as they can. They don't care if they make the problem worse, just so long as it blows up later rather than sooner. And that is what is going to happen. But I think on the emerging markets, they are going to finally be the big beneficiaries because we're going to print the dollar into oblivion. The dollar is going to crash. And then what's going to happen is a lot of the goods that are being sent to the United States are no longer going to come to the United States because nobody here will be able to afford to buy them. And so all those goods that are produced abroad will stay abroad. And so prices will come down for people in emerging markets as their currencies go way up and things become cheaper for them as Americans get priced out of all these markets because our currency is going to lose so much value that we can no longer afford to buy the things that we're buying now.